Welcome to this lesson where we're going to discuss partnership account. So, what is partnership account? What is partnership account? So, a partnership basically is a business that is run by two or more like-minded individuals with a view of making profit. That's what a partnership business is. So, for such kind of an arrangement, there's a special account that is used to handle certain affairs called partnership account. So, when two people have decided to start a partnership arrangement, they have to draft what is called a partnership agreement. Okay, so the content of this partnership agreement includes the partner's capital contributions, that is, the amount of money that each partner contributes to the business. Okay, it also includes the interest on capital. So, in partnership arrangement, if a partner adds capital to the business, they are going to be awarded some interest. Okay, so the idea of awarding interest stems from the fact that a business needs more capital. Most businesses need more capital. Okay, so if a partner is willing to add more money into the business, an interest is given to them. Okay, so that's how the partnership arrangement works. Okay, so the partnership agreement is going to give information on this interest that should be given to a partner who adds more capital or who adds capital. Okay, then there is also interest on drawings. So most of the times, as the business is ongoing, a partner may need to withdraw some money. Okay, now maybe the year has not ended, so there is no profit. Okay, but there is projected profit. Okay, the business is expected to make a certain amount of profit. So partners are allowed to withdraw some money for emergencies or any other need. Okay, so but if these partners are withdrawing some money, it makes the business to be running low on money, which is not good. So partners are not encouraged to withdraw money. Okay, to do that, an interest is charged for a partner who withdraws money. Okay, for example, if you want to withdraw 20,000, maybe an interest can be 10%, which is 2,000. Therefore, you have to pay 2,000 for you to withdraw that 20,000. So in effect, instead of withdrawing the actual 20,000, you may get 18,000, though it will be recorded that you got 20,000, because 18,000 is the actual amount you're going to get and 2,000 is going to be the interest. So in a nutshell, when a partner is withdrawing money, they are charged an interest. Okay, so these two are opposite. Adding capital to the business, you will be given interest on that capital. That is, you gain money. You can add the 20,000, and if the interest on capital is 10%, 10% of 20,000 is 2,000. Therefore, your total money is going to be 22,000. That is interest on capital. Interest on drawings is opposite. Partners are not encouraged to withdraw money. Okay, so if you are going to withdraw money, you have to pay some interest. Okay. Also, the partnership agreement is going to give details about salaries to partners. Okay, there are special arrangements in which both partners or one partner may be entitled to a salary depending on the arrangement. Think of it in this way: you and I, we want to form a business. Now, in this business, I have the skills and I'll be the one managing the business. Your job will be funding the business. So I may be entitled to capital. I may be entitled to a salary because I participate in the running of the business. Well, you do not. Okay, so salaries can be one partner may be entitled to a salary, or all partners may be entitled to salaries depending on the arrangement. The details will be given in the question. Then the most important is ratio of sharing profits or losses. Okay, so depending on the contributions, the amount of money you have put, or some other reasons, the partnership agreement should give details on what ratio of the profit should each partner get, or what ratio of loss should each partner incur. Okay, now most businesses, okay, not most businesses, but yeah, most people who don't know about commerce, they may form a partnership without the partnership agreement. So if there's no partnership agreement, how do we tackle these conditions that are supposed to be detailed in a partnership agreement? So if no partnership agreement exists, by law, profits and losses should be shared equally. Okay, if there's no partnership agreement, profits and losses should be shared equally. Also, there is no interest that's going to be added on capital. When you add more money, there will be no interest. Also, there will be no interest charged on drawings. You can just withdraw money, no interest. And no salaries are allowed to any of the partners. So in case you have a partnership and there is a dispute, you go to court. These are the conditions. Okay, the profit and loss is going to be shared equally. There will be no interest on capital, no interest on drawings, and no partner is going to be entitled to a salary. Okay, with all that information, what constitutes the final accounts for a partnership business? What we're doing is accounts, it's not commerce. So we have to know what constitutes the final accounts for partnership business. So the final accounts includes 1, the income statement, which is the other name for trade and profit and loss account. So the income statement is the same as that of a sole trader. The one for a sole trader is the one we did in grade 10. Okay, if you have not watched the video, look out for the video on a trade and profit and loss account. Okay, so that same one is the one that is used on partnership. Okay, now there's an additional part called profit and loss appropriation account, which shows the distribution of profit or loss among partners. Sorry for that. So it shows the distribution of profit or loss among partners. Then there is a balance sheet, which is just the same as that of a sole trader, but includes these details. It includes the individual partner's capital and current account balances. Okay, the balance sheet always has capital, right? But there are two partners, so there are two or more partners. Okay, so the capital of each partner must be shown in the balance sheet. Also, there must be a current account balance for each partner. Okay, so these are the changes to the final accounts from a sole trader to a partnership. The main ones being the profit and loss appropriation account and this change in the balance sheet. So in a nutshell, the new changes are: 1, there is preparation of the profit and loss appropriation account, and also the partner's current accounts that must be in the balance sheet. So these are the two additional items that makes partnership account different from that of a sole trader, I mean the final accounts. Okay, so we've talked about the profit and loss appropriation account. What is it? So this is an account that shows how net profit or loss is shared among the partners. That's all. Okay. Then what does it contain? So this profit and loss appropriation account contains the net profit for the year. It also has interest on drawings. If there were any drawings, the interest that was charged is going to be contained in the profit and loss appropriation account. Also, interest on capitals. It also contains salaries to partners and the share of residuals. Okay, so once you get the net profit, to this net profit you can you have to add the interest on capitals and remove interest on drawings and also salaries to partners. I'll show you exactly what to add and what to subtract. But the point is, the net profit has to be adjusted a bit to account for these, okay, the interest on drawings, the interest on capitals, and salaries to partners. And because of that, what's going to remain after the adjustment is what we call the share of, actually it's called the residual or the remaining profit. So this remaining profit now has to be shared. Okay, so this is the main goal of the profit and loss appropriation account. Okay, so let's take a look at some key terms that we need to be familiar with for us to handle partnership account. So drawings, these are advances taken by partners against anticipated profits. Okay, like I said, excessive drawings can weaken the business financially. Then interest on drawings is just a charge on partners' drawings to discourage unnecessary withdrawals. Okay. Interest on capital is reward to partners for their capital contributions. It is credited to their current accounts. So interest on capitals is credited to their current accounts. Then also salaries to partners. Okay, this is paid to active partners, those who are participating in the management of the business. Those who don't participate are called sleeping partners, okay, and they do not receive any salary. Those who just contribute money but they do not participate in the running of the business. Then there's also share of residuals, which simply is the share of the remaining profits after all appropriations, shared as per agreed profit sharing ratio, which is contained in the partnership agreement. If there is no ratio given, then you have to share according to capital contribution. Okay, if there is no ratio given in the question, you have to share according to capital contribution. That is, if partner A contributed 2 kwacha, then partner B contributed 8 kwacha. So 2 kwacha and 8 kwacha together is 10 kwacha. So 2 plus 8 is 10, right? So 10 kwacha. Therefore, the partner who contributed 2 kwacha must get 20% of the profit, because 2 kwacha is 20% of the total. Okay? And the partner who contributed 8 out of 10 must get 80% of the profit, because 8 is 8% of 10. Okay, so this is the layout of the profit and loss appropriation account. Okay, So of course, it has the net profit brought down. So this net profit brought down comes from the profit, the trade profit and loss account. So that net profit from the trade profit and loss account, you write it here. Then you have to add interest on drawings. Interest on drawings. Okay, so all the interest on drawings has to be added here. Think of it in this way. You have made profit. If a partner withdrew some money, they had to pay interest, so you have made more money. That interest is more money. Okay, so it has to be added to the net profit. So the total profit is going to be written here when you add the profit from the trade and profit account to the interest on drawings. So you're going to get the total profit. Now from this total profit, you have to remove the interest on capitals. Okay, if the partner adds money, they are going to be given an interest, so the business is giving away money, and because of that, this has to be removed from the profit. The money that they give, the business is giving as an interest on capital, must be removed from the total profit to be appropriated. So for partner A, for partner B. Also the salaries, the business is giving away money, so these are expenses which must be also removed. The total appropriations are going to be written here. That is the profit from here, subtracting the interest on capitals and salaries. Then you're going to have this. Now you go to share of the profit, which depends on the ratios. Okay, so we're going to do the given ratio of partner A times the capital of partner A, you get this, and the given ratio of partner B times the capital of partner B, you get this. So now let's talk a bit about the mathematics that happens here. Okay, let's take a look at an example. So let's say the net profit is 100,000, right? So now the total appropriations, that is the adjustments, it's the interest plus the salaries, it's 70. So when we do the addition, the subtraction, we get the residual as 30,000. So now we have these two partners, partner A and partner B. Their ratio is 3 to 2. So this 3 is for partner A. This 2 is for partner B. The total is 3 plus 2, which is 5. The total is very important in calculating the profit that must be appropriated to each of the partners. Okay. So for A, the ratio for A is 3, right? So you write 3 over the total 5. Okay. You get A's number 3 over the total 5. You multiply by the residual 30,000, which gives us 18,000. Okay. Again, for partner B, you do the same. You get the B's number, which is 2 over the total 5. You multiply by 30,000. You get 12,000. So this is how to appropriate the profit. Okay, so from here we're going to take a look at an example. We go through each stage. Okay, the trade profit and loss, the appropriation account, the balance sheet, and of course the current accounts for each of the partners. So let's continue. Okay, so let's look at an example. So I've got this nice example that involves Niza and Taonga, who were in partnership and were sharing profits and losses equally, meaning that the profit they make and the loss they make, they share 50%, 50%. So here's the trial balance for this business. So we have capital that was contributed by Niza and Taonga. We have drawings, and that is the man that Niza and Taonga withdrew from the business. Then we have rent received, furniture in stock, and trade debtors, trade creditors, purchases, sales, wages and salaries, freehold properties, general expenses, discounts, cash at bank, rates. So most of these entries, items, are common to the final accounts we did. That is the trade profit and loss account we did at first. Okay, there are just a few new entries like the capital that comes from both partners and the drawings that are done by both partners. Okay, then there is now additional information. Okay, so the closing stock was this figure. Okay, the interest on capital was credited at 5%, which means the interest that's going to be given to a partner for the capital they contributed is going to be 5% of the capital. Okay, then there's also interest on drawings, which is charged at NISA was charged 170, Taonga 110. So the money that they were taking out from the business, they were charged interest at those figures. Also, now there's wages and salaries. So you should note that there's already wages and salaries. So this is the wages and salaries for that year. But there is also wages and salaries which are due, meaning this is the money we were supposed to pay, but we did not pay some workers for one reason or the other. Therefore, this 304 is the money we are owing the workers, so it's a current liability. We need to pay them. Okay, then there is rent received, which includes 26 for next year. So this rent received, where is rent received? Okay, wages and sale purchases, open stock. Rent received is 156, but this whole figure is not for this year. Okay, 26, the 26, it's part of next year. So it should not, the 26 should be shown in our books that this 26 is for next year, not for this year. Okay, so then we have depreciation on furniture and fittings, which is 10% on cost, and our furniture and fittings, they are valued at this figure. So 10% of this figure is depreciation. Okay, then NISA is entitled to a salary of 2,000, so NISA must receive a salary of 2,000. Then the provision for bad debts is 10% of debtors. So 10% of our debtors, 10% of the value for debtors, this value, okay, is going to be provision for bad debts. So what is required? We have to prepare a trading and profit and loss account. We have to prepare partnership appropriation account. We have to prepare partner's current account and the balance sheet. Okay, so let's get started. So trade and profit and loss account. We start with the trading section. So the trading section is simple. We have sales. We need to know the revenue we made from sales minus the cost of sales. That's all. Okay, for us to get the gross profit. So we have sales, which is this. Then opening stock. As we started the year, we had stock that was valued at this. Then we bought more stock, which was valued at this. Okay. Then after that, when you add these two, you get the total of goods that were available in that year as this. Then we have to remove the stock that remained by the end of the year, which is this. So 173 minus this, we get the amount of money we spent in making items that were for sale, or in producing items that were for sale, or the value of the stock that was sold, which is this. So now the value, the money we got from sales minus the money we injected in producing the same goods that were sold, the difference will give us the gross profit. In simple terms, we are saying you bake a fritter at 2 kwacha, then you sell it at 3 kwacha. What is the gross profit? 3 kwacha minus 2 kwacha, which is 1 kwacha. That's what we're talking about here. So sales, the 3 kwacha is here. The 2 kwacha is all this. The amount of stock you started with plus the amount of stock you bought during the year minus the stock that you did not, that you remained with when the year was finishing. Okay. So now we are done. this gross profit will be used in the next section, which is the profit and loss section. So in the profit and loss section, we start with the gross profit you have calculated. Then most of the times after this, we have to subtract expenses. These are the expenses, so that we get net profit. Net profit is gross profit minus the expenses. Okay, so the whole purpose of profit and loss section is to give us the net profit or loss. Okay, which simply is you get the gross profit, you subtract the expenses. That's all. Okay, but sometimes if you have made some money which are not in the sales here, you need to add them. Here's the situation: you rent a factory but it's big. Okay, you sell fritters, but your factory is big, so you decide to rent out a section of the factory. So as you are renting out, that's not your primary business. Your primary business is selling fritters, so your fritters are going to, your books of accounts are going to be talking about fritters, but there is that money that comes from that space you are renting, so that will constitute this revenue you are making here, like rent received. So it has to be added to the money here. Okay, so you have to add rent received, okay, which is 156. But there was some rent that are in advance. Okay, so those ones must be subtracted. So 156 minus 26. Okay, so it's this plus this minus this. It will give us the adjusted gross income. Once we adjust the gross income, we have to subtract the expenses such as wages and salaries. Wages and salaries, which is this. Wages due. This is an expense. Remember the wages due that was found in the additional information. Okay, this one, it's an expense as well. Okay, there are two wages and salaries. There's wages and salaries on top, then there's wages and salaries due. So both of them are expenses. Okay. Then we have general expenses, we have discount allowed. When you allow a discount, that's an expense. We have rates, we have depreciation. As you are using machines, the machines are losing value, so you are losing money. Okay. Then we have provision for bad debts, which is the 10% of the total trade debtors. Okay. So we add this, we get the total expenses. Now when we subtract the adjusted gross income from the total expenses, we get the net profit. So this is our net profit. Okay, now we're done with the trade profit and loss account. Now we go to parts that have to do with the actual partnership account, the appropriation account. So the appropriation account is simple. Okay, it's very simple and very short. So start with the net profit that you made from trade profit and loss account. Then after that, you have to add interest on capitals. So for NISA, the capital for NISA was 20,000 and for Taonga was 14,000, as we can tell from the trial balance. NISA 28,000, Taonga 14,000. So 5% of 20,000 will be the interest and 5% of 14,000 will be the interest. This 5% comes from this statement here, which says number 2, interest on capital is 5%. Okay, so 5% of 20,000 is this, 5% of 14,000 is this. Then you also have to add the salaries. Okay, we have NISA's salary, which is 2,000, right? So when you add, you get the total appropriation, which is this. Then from this, you have to remove the drawings. Okay, so we're going to remove the interest on drawings. Okay, which is for NISA it was this, and for Taonga it is this. Okay, so once you add, you have to remove the interest on drawings. Okay, and once you remove these two from this total appropriation, you get the residual profit for sharing. So this is the profit that's going to be shared. Okay, so for NISA it's 50% and for Taonga it's 50%, according to the instructions that we were given at the beginning, where it says NISA and Taonga were in partnership, sharing profits and losses equally. Okay, so going back, so equally means 50%, 50%, right? So NISA's share is 50%. So 50% of this is this. You just have to get a calculator, you do 50 divided by 100, then you multiply by this figure, you get this. Okay, and Taonga's share, it is the same amount. Okay, so you are done with your appropriation account. Now it should be mentioned that always look for rule. It's not always that it's going to be 50%, 50%. Sometimes they can say NISA will be getting 70% of the salary, while Taonga will be getting 30% of the salary, which means you have to do 70% of this to get this, like 70 over 100 times this, or 70 divided by 100 times this, okay? And Taonga 30 over 100 times this for you to get this, okay? Sometimes when they say there's no partnership agreement, it means it's 50%, 50% when there's no partnership agreement. Otherwise, when there's partnership agreement, they should state, okay? Then sometimes they can share profit based on their capital contribution. That is, for NISA, for example, you go to the capitals, okay? So the capital contribution from NISA is 20,000. So you get this 20,000, you divide it by the total of the two capitals. So the total capital is 28 plus 14, which is 42,000. So for NISA, it's going to be 20,000 divided by 42,000, which is going to give you oh, sorry, I want to calculate that. So it's going to be 20,000 divided by 42,000. Let me see if I can show you the actual calculation. So it's going to be 28,000. Okay. No, I've left my pen. Okay, let me see. Okay, so you get NISA's value 28,000. So I'm using a computer without a pen. I thought I was using my other computer. So divided by the total 42,000. You can do this on a calculator. Okay, then you multiply it with the profit. Okay, in this case the profit is this. I mean, not the profit, but the residual profit, 18. Okay, so you multiply it by 18,000 what 18,000 what, but you get the point. So this is as share divided by the total times 18. Okay, so that's how to those are different ways to calculate, to share the profit. Then after that, you go to partnership current account. So this may look a bit different, but it's something that we're familiar with. Okay, so normally we have the debit side on the left and the credit side on the right, but in this layout we are going to write the debit balances first and then the credit balances first, okay? Just for because there are two partners, there are two accounts, okay? So for NISA, the drawings and the interest on drawings are going to be on the debit side, okay? In fact, for both of them, the drawings and interest on drawings, you put them on the debit side. So the drawings for NISA is this, then the interest on drawings for NISA is this. The total debits are this. Even for Taonga, the drawings are this, the interest on drawings are this, so the total is this. Then now we go on credit sales, okay? I mean credit side. So here we have done the debit side. Now we go to the credit side for each of the partners. Okay, so interest on capital is this. Interest on capital is put on the credit side. The salaries are put on the credit side, and the share of residual profit are put on the credit side. So these are the main items we deal with in the current accounts for them. Okay, so the drawings and interest on drawings, debit side. Interest on capital, salary, and share of residual profit, credit side. Okay, so for NISA it's this, for Taonga it's this. It should be noted that Taonga has no salary, so there is no figure for salaries for Taonga. Okay, so the total credits are this. The total credits for Taonga are this. Okay, so what I want you to know is in the current account for each of them, the drawings and interest on drawings, debit side, interest on capital, salary, and share of residual profit, credit side. With that, we get the total credits. Now we need to balance. Okay, I know we are used to where the debit side is on the left and the credit side is on the right. Here the debit side is on top and the credit side is on the bottom. Okay, so if you compare for NISA, the total debit side is 6,970. Well, the closing balance is 5,728. So the big number is where is the big number here of 6,000? Sorry, here we have 12,000. Yes, for NISA of 12,000, right? So meaning that we have more money on the credit side. Therefore, we're going to have a closing balance on the credit side. So when we do this minus this, that is total credits minus total debits, we're going to get the balance, right? Which is this. Okay, the difference between total credits and total debits will give us the closing balance. Since the credit side has a bigger number, so we're going to have the closing balance on the credit side. Even for Taonga, the same story. Okay, so we have total debits this, total credits this. Difference gives us the credit closing balance of this. So we are done with partner's current account. The last step is the balance sheet. These two figures are going to be used in the balance sheet. Okay, this figure, the closing balance for each, and this figure. So the closing balance for each of the partners are going to be used in the balance sheet. So the balance sheet starts just like any other balance sheet with the fixed assets first, freehold property, and furniture and fittings. Okay, if there's depreciation, you have to subtract depreciation. The depreciation for furniture and fittings was 175.9, but I've rounded off to 176. Okay, which is 10% of this according to the instructions we were given. Okay, so 176, I mean this figure minus this, we're going to get this. Okay, so the total fixed assets are this. Next, we go to current assets. So the current assets, we have the closing stock, right? Then we have debtors. Then from the debtors, we have to remove provision for bad debts, which is this, right? So debtors minus provision for bad debts. Wait, let me see. What was the percentage for provision for bad debts? So provision for bad debts is 10%, so it's okay. Okay, so 10% of this figure, it's this. So this minus this will give us the total debtors. Okay, then we get cash at bank, which is this, and the prepaid rent. Prepaid rent is a current asset. Okay, so it should be included here. Okay, so when you add this, you get the total current assets. The idea is we need to know the total value of assets. We have the fixed assets, we have the current assets, but current assets, we need to subtract the current liabilities. Okay, so we have to also consider current liabilities. Most of the times current liabilities will be creditors, but in this case we had something new, the wages that were due. Okay, so wages and salaries that are due, we have to add them to current liabilities. So when we add, we get this. So now current assets minus current liabilities will give us the working capital or the net current assets. Okay, so net current assets or working capital is total current assets minus current liabilities. Okay, you can show them in a table or just by such a calculation, but a table is okay. Okay, then after that we have to get the total assets, where we add the current assets, the net current assets with the fixed assets. So these fixed assets we calculated here, we're going to add the total of the net current assets to get the total value of the assets. Okay, so now remember the balance sheet is about the accounting equation. Assets is equal to capital plus liability. Okay, so assets, we have dealt with them. Next we need capital and liability. So capital, you start with NISA's capital, which is this figure, Taonga's capital, which is this figure. Then we have NISA's current account balance. Remember the current account balances that we get from the current account. Okay, this figure and this figure. So you indicate them in the balance sheet on this stage. Okay, so NISA's current account balance, you indicate. Total current account balance, you indicate. So you add the total. If there are some long-term liabilities, you also have to include. Okay, so you add the total, you get the this figure. So this is how to deal with partnership account. See you in the next lesson.